morning, everybody, and thanks for dialing in. Welcome to KBRA's Aircraft Engine webinar. My name is Caitlin Colvin, and I'm a Managing Director in the Business Development Group here at KBRA with a focus on investors. For those of you who may not be aware, KBRA is a global rating agency with more than 360 employees with 5 offices. We have 3 offices in the United States and 2 over in Europe. Globally, we've rated over 2,000 issuers and transactions. I'm joined by Marjan Riggi, a Senior Managing Director and Head of KBRA's Transportation Ratings. I'm also here with her team, which includes Denise Choi, a Senior Director, and Boris Alashayev, a Director. Marjan and her team will be taking you through today's webinar that will focus on aircraft engine-backed transactions. As a reminder, all KBRA research and reports are available free of charge on kbra.com. This includes Marjan and the team's recent piece regarding the engine-backed financing and how it's been gaining momentum with institutional investors. We'll be holding time at the end of the webinar for questions. At any point during the presentation, please feel free to submit questions through the GoToMeeting, and Marjan and team will be able to respond at the end of the presentation. Without further ado, I'd like to hand it over to Marjan.
Thank you, Caitlin, and good morning, everyone. And thank you for joining our first webinar on market trends in engine financing. Our goal today is threefold: to engage investors with key market trends in recourse funding for engines, especially EETCs, talk about KBRA's approach to rating such financings, and finally to cover how engine valuations impact deal structures. I will do a short intro followed by Boris and Denise, who will do the rest. Now let's turn to slide 5. First, to say that most aviation financiers have long recognized the unique quality of engines. They have long, useful lives, replenishable value at predictable intervals, and fungibility for different types of aircraft in some cases. These qualities make engines very attractive for investors who look for long-term cash flow and yield, as well as more predictable though complex to calculate residual values. Airlines, engine lessors, or other owners of engines have traditionally looked to banks for financings, which have provided them with very favorable rates. The ABS market for engine lessors has been active too, and lessors continue to use ABS backed by pools of engines leased to diversified lessees. We won't go into much detail on ABS structures here, but later Denise will cover how engine valuations affect their liquidity, which applies to all deals backed by engines, regardless of their financing structure. We also have Alan Greenblatt, our ABS analyst, in the room for Q&A later. But apart from bank loans and ABS, we have noted recently among investors a rising interest in recourse debt backed by engines. Engine lessors with strong credit metrics, as well as airlines, are considering various forms of secured transactions given their simpler structures and relative ease of execution versus the more complex ABS, which may not appeal to all investors. In our observation, the EETC structures are gaining momentum with airlines and investors alike, given their structural features which make repossession of collateral in case of default more predictable and easier to model. This is because engines benefit from the same legal framework as aircraft EETCs and can be easily used by airlines to raise funding in debt markets. In fact, rates on such deals can be the same or even better than aircraft EETCs due to their intrinsically higher value and longer useful lives versus airframes. So why is it that for airlines, EETC like debt backed by spares makes a lot of sense? It's mainly because their senior tranches could be rated multiple notches above the rating of the airline itself, and tend to be typically in whose ratings tend to be typically in non-investment grade category. Now turning to slide 6, I want to highlight a few things about the relevant size of the engine market as potential for capital market financing. Obviously, engine deliveries and orders have grown in lockstep with aircraft to meet the rising demand for travel globally. For example, CAGR for engine deliveries are estimated to be around 5.3% from 2016 through 2019. As a general rule, on-wing engines which are delivered with an aircraft are funded as part of that aircraft financing and not separately. But for every on-wing engine, operators have to think of spares for when the working engines need to go for performance restoration shop visits. Depending on the type of engine, their life cycle phase, and age, such visits can take anywhere between 2 to 4 months and even longer. The size of the spare engine market is estimated to average around 10 to 12% of all engine deliveries. Given that the approximate size of orders for 2018 was around 100 billion, we can assume that the financeable market for spares would be around 10 billion for the 2018 orders. Another key thing to highlight for investors is that spare engines are completely identical to their equivalent on-wing engines and are designed to fully replace them when they're down for shop visits. Installation of spares is an expensive and time-consuming process. Once spares are installed on wing, they will stay there until it is their turn for longer visits in most cases. Most airlines don't want the disruption of having their aircraft on the ground for longer restoration visits and therefore either lease spares or buy them to have them on hand when needed. And this is the part that needs funding separately from airframes. Finally, the pie charts on this page show both the in-service and order books for the different types of engines and their market size. Key takeaway here is that not only engine order books have been strong, but that newer, more efficient, and technologically advanced models make up a good portion of the current order backlog. These engines are favored by investors because of their efficiency, value retention, and forecasted longer intervals between maintenance visits. Though interestingly, recent problems with some newer engines have driven up demand for spares to fill the gap. Still, many operators view that significant fuel savings on newer models outweigh the entry into service maintenance issues. This concludes my remarks, so I stop and hand over to Boris, who will talk about our rating approach for secured engines.
Thank you, Marjan. We've received a number of inquiries from market participants to provide some clarity on the key risk factors that we consider in rating EETCs and secured loans backed by aircraft engines. The ratings of EETCs and secured transactions backed by engines are covered by our global EETC and secured aircraft rating methodology, while the ratings of secured and unsecured debt issued by engine lessors are covered by our global finance company rating methodology. Like the traditional aircraft EETCs and other secured debt, our rating approach for engine recourse transaction focuses on the credit quality of the airline or lessor, the engine pool, and critically their strategic importance to the airline. Our rating approach also considers the payment waterfall, as well as the structural features such as tenor of the liquidity facilities, PIK, and the robustness of the financial covenants. With the assistance from our legal ratings team, we conduct an in-depth jurisdictional analysis of where the carrier or lessor is registered and where the engines are used. Our global passenger airline rating methodology provides a framework for assessing airline credit risk. The review includes an analysis of both business and financial risk indicators, where the former generally captures qualitative aspects based on KBRA's view of the carrier and the airline industry. In evaluating the underlying collateral quality, we focus on the airline's fleet composition and order book in the context of its long-term fleet strategy. The fleet composition and its evolution are key drivers in our view on the likelihood of the affirmation of the engine EETC and secured loan in the event the airline files for bankruptcy. It is critical for airlines to maintain spare engines to ensure smooth operations during periodic shop visits of its fleet. Often the spare engines rated by our team are already mounted on the wings and are in use. The overall quality and composition of the engine pool is another key credit determinant in our analysis. Aircraft engines have long useful lives and generally retain their values as engines are overhauled during shop visits. We view the life cycle of the host aircraft for an engine model as well as the maintenance condition of the engines as the primary drivers of the engine fleet value, which Denise will go into further details later in the call. For aircraft engines in ABS, our assessment focuses on the operational abilities and the servicer financial strength, the composition and the quality of the engine pool, as well as the receipts and underlying cash flow, lease payments, and sales under stress scenarios. ABS backed by engine portfolios are covered by KBRA's Global Aviation ABS rating methodology. KBRA has rated several aircraft ABS transactions, including structures for Willis and GCAS. From a rating capability standpoint, on the corporate side, we have expertise to analyze traditional WETC-like structures, as well as bespoke engine-backed debt transactions that might incorporate elements from both structured finance as well as elements from corporate term loans. We also have capabilities to work on non-USD denominated transactions or on transactions that lack benefit of Section 1110 or Cape Town Convention. Flipping to the next slide. Table on slide 9 provides high-level summary of the similarities and the differences when it comes to rating transactions backed by aircraft collateral versus engine collateral. As you can see, the strategic importance of both asset classes for the airline operating strategy and the legal protection that bankruptcy law provides creditors are the driving factors that prompt management teams and bankruptcy administrators to set high priority of payment for these types of transactions. Both asset classes benefit from similar structural features and legal framework. KBRA typically uses maintenance-adjusted base values when calculating LTVs for engine-related transactions, since maintenance status is directly linked to the value of the engines, especially as the engine ages. From the useful life perspective, engines tend to have longer useful life than airlines, providing investors with additional level of protection. Unlike for aircraft WETCs that consist of individual equipment notes, engine assets are typically pooled. We have yet to see a delayed draw feature on the engine transactions, but don't eliminate the possibility in the future. We have also observed greater use of financial covenants and greater need for annual appraisals for transactions backed by engines, given higher valuation volatility. And with that, I'd like to turn the call over to Denise, who will discuss the valuations.
Thank you, Boris, for giving an overview of KBRA's rating approach for engine transactions. Now we are on slide page 11. Asset valuation is a critical component of any aviation financing. Since many of you are familiar with our EETC methodology, I'm not going into details on how we use and stress valuation in our loss simulation today. Instead, I'm going to focus on how engine values behave differently from aircraft, and how our approach may be adjusted to account for these differences. Similar to aircraft, engine values are influenced by a wide range of factors, such as operator base, geographic concentration, supply and demand, technological obsolescence, and maintenance status, etc. But they are influenced by these factors to different degrees. Engines typically have longer useful lives and retain value better than aircraft over time. Their values can be substantially replenished from an engine overhaul and is highly dependent on the maintenance conditions, even more so than aircraft. While aircraft values decrease with age, engine values actually decrease with the utility left in them. To illustrate, let's look at these two graphs which MBA had produced. For a narrow-body aircraft, on average, less than 30% of the value is attributed to its engines compared to the airframes. At 10 years of age, over half of the value is attributed to its engines, and at 15 years of age, the percentage go up to 80%. Wide-body aircraft demonstrate a similar phenomenon, but to a lesser extent. In order to understand the reasons behind, let's turn to the next page, page 12, to first understand the life cycle of an engine. The life cycle of engines is divided into 3 parts: Phase 1, Phase 2, and Phase 3. Phase 1 starts from the introduction into service of the engine and its host aircraft. That is the aircraft which the engine support, and it ends roughly at the end of the production of the host aircraft. In the table to the right, you can see the engines currently in service and their host aircraft. During Phase 1, the demand of engines is high and increasing because of the increasing needs for spare engines. Values during this phase tend to increase slightly, driven by inflation and escalated cost of production. Phase 2 begins when the host aircraft production run stops, or in some cases, production run hasn't stopped, but very few orders remain, while the next generation replacement aircraft has already entered into service. Phase 2 ends when the host aircraft begins retirement. The large number of aircraft that will continue to be in service for many years continue to support the engine's demand. Values generally decreases slightly over time. It's worth noting that due to the long production runs and high production rates of many of the aircraft types, Phase 2 engines account for the bulk of the existing engines in service, approximately 80%, as you can see in the pie chart. Phase 3 starts when the host aircraft begins to retire from service. OEMs no longer produce the supported engines. During this phase, spare engines demand decreases and more spare engines become available as airframes are scrapped. Values tend to decline significantly and become more volatile as they are driven more by short-term demand and supply. Engines with more green time left will retain more value, while others will be broken down for parts. Now, if you recall the 2 graphs from the previous slide, let's say for an aircraft that had newly entered into service, its value would have depreciated 5 to 10% each year. But for the engine supporting such aircraft, their values would have increased modestly for quite a number of years until the production runs stop, and then they start depreciating. Therefore, the engines retain so much more value relative to its airframe. In any engine transactions, KBRA will analyze each engine type and determine where each engine type falls in its life cycle. When modeling for these transactions, KBRA typically applies a higher haircut to Phase 3 engines than Phase 2, and in turn, the stresses for Phase 2 will be higher than for Phase 1, all else being equal. But as mentioned before, engine's value can be influenced by many other factors, which we also take into consideration. Similarly, KBRA applies forward-looking depreciation curves to each engine types. It is important to note that an engine in the same phase can still have very different depreciating curves. For example, an engine type with a small operator base supporting a wide-body aircraft that is towards the end of Phase 2 will certainly have a much steeper depreciation curve than an engine with a wide operator base supporting a narrow-body aircraft that is in the beginning of Phase 2. Now, let's flip to page 13, where I'm going to talk about the engine maintenance conditions. So far, we have established that engines generally retain better values over time than aircraft. But it is very important to note that each individual engine is highly dependent on its maintenance status or the utility left until the next engine overhaul. During an overhaul, engines are repaired and restored, and the life-limited parts are replaced. As you see in the graph, engine values decreases as the engines are used, usually measured by flight time, and then restored by an engine overhaul. These are repeated many times during the life cycle of an engine, while aircraft demonstrate similar ups and downs because of the different components of an aircraft. For example, its APU, landing gears, and airframes. The difference between full life and run-out values for engines are amplified. KBRA loss simulation for engines transaction typically starts with maintenance adjusted base value, which better reflects the engine values. But understanding the higher value volatility driven by the maintenance condition, KBRA generally looks for mitigating factors such as larger pool size, as well as diversification in terms of engine types and where the engine falls along their maintenance cycles. In addition, regular updated appraisals and LTV triggers help to mitigate the volatility in values. For transactions that lack these mitigating factors, a higher stress or haircut in values will be applied. With that, the presentation part of our webinar is concluded, and we are happy to take your questions.
Hello, this is Marjan again. We have a number of questions that we're going to try to answer. I think that one of the first questions is, what are the key drivers of engine bank-backed portfolio evaluations, i.e. what the attributes of a given portfolio that investors care the most about? And Denise, can you please?
Yeah, let me take this question. I think on the high level, when we receive an engine portfolio, what we really look at first, we try to divide the portfolio into phase 1, phase 2, phase 3 engines. As I try to explain in the life cycle of engines, really the phase 1 are more desirable because they have a much longer useful life as compared to, let's say, the phase 3, and that their depreciation, or actually on the opposite, they appreciate for a little while before they started depreciating. So we first look at the composition of the phases, and then next we really look at the portfolio as to the maintenance condition of the engine types. So when you talk about attributes, it's really about whether the engines are in high demand. So in addition to look at the phases, we really look at what types of host aircraft they are supporting. So as you can imagine, the engines that support liquid narrow-body aircraft are in more high demand than wide-body aircraft or less liquid aircraft. So these are typically the attributes that I guess investors care about.
Okay, the next question is a very interesting question that came from one of the callers about that granted you have longer useful lives for engines, but what about volatility and predictability of cash flows, as lease terms tend to be shorter than they are for aircraft, especially in the case of being used in ABS deals? I think that this really is an ABS type of questions, because these kinds of deals are usually done in the ABS market. And Alan Greenblatt is here who could answer that.
Sure. So KBRA has looked at a number of engine aircraft ABS transactions, and the ones we looked at to date, usually the lease term for the engines are a little shorter, which is all accounted for within our stress scenarios. We have different ranges, as Denise mentioned, based on phases and lease rate haircuts. So as the engines continue to probably have go off lease more so than an aircraft ABS transaction, it would actually be stressed more times than you would in an aircraft transaction, which we assume about 3 to 5 years for a current lease, where an engine could be on a short-term lease for 12, 24 months. And at the end of each lease, we assume additional downtime as well as additional haircuts to those engines. So this should account for the additional volatility that may incur from engines and the shorter lease terms that they may have.
Another question that came up is, why do wide-body aircraft engines retain less value than narrow-body aircraft engines, understanding that they still retain more value than the respective airframes?
Let me take this one. It's mainly because on average, wide-body aircraft has shorter production run than narrow-body aircraft. Therefore, wide-body engines has fewer number of years of phase 1, meaning like they have less time of appreciating values before they start depreciating.
Thanks, Denise. And this, I think, concludes our prepared remarks. I'm going to hand over to Caitlin to close.
Thank you all very much again for listening in. If there are any follow-up questions that you might have, please don't hesitate to reach out to the team. The contact information is included in the presentation. We very much appreciate your time. And again, please feel free to, at any time, log on to kbra.com for free access to all of our pre-sales research and reports. Thanks so much.